Let's jump right into this explainer. Today, we're breaking down a really complex Q1 2026 earnings report from medical device manufacturer Integer Holdings. Now, if you track the medtech sector, you know that making sense of earnings right now, it's tough. You've got to balance immediate macro pressures against these huge long-term pipeline promises. And, well, Integer has basically become the ultimate case study for this exact dynamic. They just dropped a report that pulled the market in two totally opposite directions. So look at this question on the screen. Why would a company that is so confident in its long-term strategy suddenly want to explore a sale? That's exactly what investors are trying to figure out. Integer paired a really tough 2026 financial outlook with a massive surprise announcement. Normally, when leadership says, hey, our pipeline is incredibly strong, we're going to beat the market, they just put their heads down and get to work. But Integer, they just open the door to a potential buyout. It's a fascinating puzzle for us to solve. To make sense of all these mixed signals, here is our roadmap for today. 1. The strategic review surprise. 2. Q1 results and that margin squeeze. 3. Navigating the 2026 headwinds. 4. The bull versus bear debate. And finally, 5. Looking ahead to 2027. But before we dig into the financials, we really need to nail down Integer's core identity. They aren't some tiny startup. They are a massive outsourced manufacturer. Think of them as the company that the biggest names in medtech rely on to engineer and actually build life-saving devices. They provide the literal picks and shovels for the industry. Because of that, their financial health is a fantastic barometer for the whole medical device supply chain. All right, moving to section 1, the strategic review surprise. Why now? Well, management insists they are highly confident in their standalone strategy, but they are kicking off this review simply because outside interest is heating up. On the earnings call, CEO Payman Khales was super direct. He said the board has a strict fiduciary duty to maximize shareholder value. So even though they think their current path is great, all these inbound inquiries basically force their hand. They have to at least see what the market is willing to pay for their manufacturing muscle right now. Here's the key takeaway for you. While a blockbuster buyout is totally on the table, the board is equally ready to just stay the course if that's what creates the most value. They were very careful on the call. No promises of a sale, no specific timeline, and definitely no guaranteed outcome. Yes, they're shopping the company around, but their fallback plan is just running the business as usual. And that means the underlying fundamentals still matter a whole lot if you're holding the stock. Which brings us to section 2, Q1 results and the margin squeeze. Let's unpack the numbers. That number right there perfectly illustrates the immediate hurdle. Integer's adjusted operating income margin dropped by a heavy 230 basis points. That is 2.3%. Now, in the manufacturing world, a margin squeeze like that sets off serious alarm bells. When your costs stay flat or go up, but your production volume or pricing power goes down, that compression hits your bottom line incredibly fast. It's really a classic mixed bag. Top-line organic sales did manage a slight 1% increase, which was actually right in line with their expectations. But because volumes were lower, they just couldn't absorb their fixed costs as efficiently. That's what drove the profit squeeze. So how did they land an adjusted EPS of $1.20? Well, they pulled some pretty smart financial levers. They saved $4 million on interest from a previous debt offering, and they executed a hefty $50 million share repurchase, dropping their share count by 2%. So how does that margin pressure carry forward? Let's get into section 3, navigating the 2026 headwinds and adjusting the outlook. Management actually lowered their full year 2026 sales outlook to a max of $1.835 billion. And honestly, this was the toughest pill for the market to swallow. They are risk adjusting their outlook because their big customers in the cardiovascular and broader medtech space were updating their own forecasts. You can literally see the pain points right here in the table. Adjusted net income is now projected to be down anywhere from 3 to 11% year over year. To fight back, they are actively taking aggressive cost reduction steps to protect that bottom line. But it's a tightrope walk, right? They need to slash immediate variable costs to offset that 230 basis point drop, all while keeping the balance sheet healthy. Currently, their leverage sits at 3.2 times, which safely keeps them inside the target range. But here's the most important part. They absolutely refuse to cut the 2027 structural research and development investments. They know they need those for future product launches. This tug of war between aggressive cost-cutting and future promises leads us directly into section 4, the bull versus bear debate. Let's weigh the evidence. So if you're a bull, you look at the math and say, hey, this stock is trading almost 13% below its fair value of $101.33. Add in a strong pipeline and management's promise that revenue will normalize in the second half of the year, and it looks great. But if you're a bear, you are staring right at a trailing net margin of just 5.5%, not to mention a PE ratio sitting at 29.3 times earnings, which is noticeably higher than the industry average. Bears are definitely worried that their debt might start feeling a bit too heavy if operating cash flow tightens up anymore.
All right, let's turn to Section 5, looking ahead to 2027. This is the long-term promise.
The absolute cornerstone of the bullish argument and management's confidence is their rock-solid guarantee that organic sales will aggressively outpace the market by 2027. Seriously, even though they lowered the 2026 guidance, they didn't budge a single inch on 2027. They're predicting their end markets will grow at about 4 to 6%, and they are promising investors that Integer will beat that market rate by a full 200 basis points next year. How are they going to do it? Through a heavily diversified pipeline. They're specifically banking on their electrophysiology, or EP business, to deliver massive 15 to 20% growth over the next few years. That EP portfolio is really the golden goose here. They've made heavy investments in the past, and even with some recent market softening, they expect this specialized segment to be a huge catalyst. Plus, they're quick to point out that their product portfolio is broad. They aren't just crossing their fingers for one or two blockbuster devices to save the day. The growth is spread out across a really deep bench of innovations. Ultimately, what leadership is doing here is projecting absolute stability. They want to assure the market that daily operations won't miss a beat, even while the board shops the company around. As the CEO noted, this strategic review doesn't change their focus on delivering on financial commitments. They're sending a very clear message to both Wall Street and their massive OEM customers. The strategic review happening in the boardroom is not going to distract the engineers working on the manufacturing floor. So, will Integer's strategic review result in a blockbuster buyout? Or are they going to be forced to execute this 2027 standalone turnaround under the intense microscope of the market? That is the ultimate question you need to take away from this explainer. We've got a company facing very real margin compression today, sitting on a pipeline they believe is wildly undervalued. Whether this ends in a lucrative sale or a gritty standalone comeback in 2027, these next few quarters are going to be absolutely fascinating to watch.